Hello, everyone. Today we'll talk on the topic corporate governance and growth. So, exactly, is it minimum governance and maximum growth, or maximum governance, maximum growth? Which is that system, rules? Let us discover corporate governance and growth. So, first and foremost, way back in 1992, contemporary corporate governance began in the advanced economy, let's say the United Kingdom, with the Cadbury report. The Cadbury report was several high profile company collapses. And why was it? It was the governance issue as a result why several high profile company collapsed. The mismanagement, the nepotism that was kept in being either ignored or been inculcated, which eventually led to the demise of such big conglomerates, became the concern of why you need to be protecting the weak and widely dispersed shareholders against vindictive or selfish directors and managers of these big entities. That is where the corporate governance took into places way back approximately 31 years from today. So let us understand the corporate governance parties. First and foremost, are the minuscule shareholders or everybody who is a part owner of the company, those who own the company. Then there are something called guardian. These are mandated guardians who are manning positions so as to see the benefit of the organization, the directors, the managers, the executives out there. They are the company's assets for the shareholders. And last but not the least are the managers who actually utilizes the company's asset for the overall benefit. Corporate governance primarily concerned with every listed companies, let's say any listed company that is there being listed in the stock exchange, focus on preventing corporate collapse such as Enron, Polypec, and Maxwell companies. What relevance does it have to Africa? When there are few listed companies, does it? But today it might be very few listed companies in Africa. Give it a time. In another 5 years' time, the number of listed companies in Africa is going to grow more than 5 times in next 5 years' time. See the rate of growth. Most companies are non-listed. Most companies are not making mega profit, but these are only due to come private family owned businesses where shareholders and managers are often one and the same people. They're identical people, they're identical person. Four pillars of corporate governance: accountability, fairness, transparency, and independence. Accountability. Let us understand what is it all about it. Ensures everything is accountable. Accountable money which is coming in, money which is going out. What kind of money is coming in? What kind of money is going out? To whom the money is going or to whom from whom the money is coming in, and it is not related to the money part only. It is related to any equipment, any capital expenditure, any operating expenses. You need to be accounting it. Ensure the fact that these expenses are only business related and not person specific. This means the board becomes accountable to the shareholders. So be accountable. Then becomes the fairness, protect shareholder right, treat every shareholder, no matter how many numbers of shares might be they having. They might have 0.0001% of the total share of the company, but make them equal with the person who is owning approximately 10, 15, 20% of the company. They are equitable, they are as part owners, they have the same vested interest. So you have to be fair. You have to provide effective redress for the violations. Transparency. Ensure timely, accurate disclosure in all matters, including the financial solutions, performances, ownership, and corporate governance thereby. So let us talk about independence. What are this? These are the rules, these are the regulations which are independent of the people out there. A system has to be in place, a procedure has to be there, a structure has to be there so that irrespective of the individual manning those positions, you need to go through, the work has to flow to a certain systems, that this will avoid all conflict of interest. Be it the independent director, be it the advisor, they will not be able to influence other. They will not be able to employ their whims and fancies through others, because system would be barricading them. System would be deterring them for making any such nuisance. In 1994, the King Report in South Africa, remember the King Report in South Africa also included its codes of conduct for corporate governance on sustainability, on ethical standard. This was due to the context that Africa is a developing country, and business ethics needs to be put in the system, put in the DNA of the company, ensure that there is a regular reporting every quarter, if not every month, about their expenses, about their investment, about their projections, and so on and so forth. The reasons sustainability, nothing that meets the needs of the present without compromising the ability of the future. Remember, nothing that meets the needs of the present without the compromising of the future. So you cannot do anything which is going to be detrimental at the expense in the future ahead. You cannot do anything as of today which will affect in a negative fashion 5 years, 10 years, 20 years down the lane to meet their own needs. So you have to take into consideration what will happen in 5 years down the lane, 10 years down the lane, 20 years down the lane, and only perhaps then proceed with caution. Stakeholders, sustainability recognizes stakeholder rights, the right of the interested parties, the employees, the community, the suppliers. We talk about the customers. Encourage cooperation between companies and stakeholders in creating wealth, in creating jobs and economic stability, as the case might be. This is of vital importance. This is very important. So, business ethics, establish values, principles a company uses to inform and conduct its activities should permeate a company's culture and drive its strategy, business goals, policies, and activities usually found in a code of conduct, as the case might be. That is what is business ethics. Now, you need to understand those established values, the principles a company uses to inform. Elements of corporate governance, good board practices, transparency. Ensure there is a transparency, and that itself is a good board practices. Controlled environment. Ensure everybody has a limit to their influences. Everybody should have limit and accountable. Everybody should know what is happening. Transparent disclosures. Well defined shareholder right. As I've said, the periphery of the right, the influence should be well defined, and the board commitment. We are talking about the good board practices. Let me clarify. It should be talking about specific roles, specific authority, specific responsibilities, specific duties that a person needs to imbibe and display. The directors need to understand what is expected of them. The board should be well structured, appropriate combination, and the mix of skill is what we are looking for. Next is the procedure. What is a good board procedure? You should have the decorum. You should understand the rules and probably the bylaws of the companies, the vision and the mission. Director remuneration should be in line with the best practices. We are talking about self evaluation. We are talking about training. We are talking about upgrading your ante altogether. Yes, there is a control environment. Internal control procedure works best, and it need not be audited every now and then. Remember, auditing is always been done by the third party or probably a government intervention, but that is bad for your health if an audit finds the flaws in your system. So it is better that you do keep on auditing yourself. Your internal control procedures should be in place. This helps you in averting the risk. This helps you in probably mitigating any disaster. You should always ensure the media management skills are very appropriate and they should be taken in consideration. Then is what we talk about the control environment. This is where the business continuity should always be procedures. If there is a cyclical nature in the business, you should ensure it, you should embrace it, you should make the most of it. Independent external auditors conduct audit, as I've already stated. So independent audit committee should be established. This helps to keep the business error free and probably not prone to any kind of corruption. The internal audit functions, the management information system, MIS, should be established. They should give you certain data points every week. Forget being week, every day, certain data points which you should be able to read, whether and interpreting them will give you a brief idea whether the working of the company is going on the right direction or not. That is what we are looking for it. Next is your compliance function, whichever is established by the federal government or the local government. The compliance issues should always be catered to. Transparent disclosures, financial information should be disclosed, as in the flow of money. Non-financial information should be disclosed, as in what are activities that are undertaken, why was this important. If you are treating a client in a big expensive property, why was it required in the very first place. Financial reporting system, international financial reporting system, is what we should always write the reasons, as in why an expenses have been made, why and in money has been utilized in a particular fashion. This is where we come to the transparent disclosure, company registry filling up to the date, high quality annual report published, web based disclosure is what we are looking for it. Well defined shareholder right. I know what are we talking about. Well defined shareholders, irrespective of what that you might be holding n numbers of share or probably just one share, everybody should be treated on an equal footing. Everybody deserves the respect because they believe in the shared value of this company. They believe in the vision of the company. As a result, they have invested, right? So, well organized meeting should be there. Annual general meeting should be a must to disclose what the company or what the management of the company is thinking for future courses of action. Policy related to party transaction needs to be taken into consideration. Well-defined shareholder rights, policy on extraordinary transactions clearly defined, explicit dividend policies as the case might be. Now we are talking about the board commitment. The board discusses corporate governance issues and has created a corporate governance committee in the first place. This is where everybody will be kept at toe. The company has a corporate governance champion. The corporate governance improvement plan should be created, updated, and upgraded in due courses of time. Appropriate resources are to be committed to the corporate governance initiative. Now we're talking about the board commitment. This is where the policies and procedures needs to be formalized, mentioned in black and white, and probably disseminated to every staff associated with their work. A corporate governance code has to be arranged, has to be developed, and has to be ingrained in the system altogether. This is what we are talking of corporate governance. And for doing a right way of operating a business, there should be certain ethical standard that you should be adhering to. A company is recognized as a corporate governance leader thereby. So what are the other entities that we keep on talking around it? Corporate governance applies to every item, all the items of the organization, from the top to the bottom. Examples are NGOs, schools, hospital, pension fund, state-owned enterprise, and so on. Now we give you a brief service country perspective. You know what happened with Sarbanes-Oxley Act? This was where the system, the corporate, the companies goes bankrupt without any audit firm, without any regulatory body even finding out the flaws around it. This has a big blow to the society where the companies are from operating. That is the reason why in 2002 we have the Sarbanes-Oxley Act. Corporate governance is the way of legislation of best practice. And best practice is to report what is happening. Report every quarterly what is happening in your company. In your annual general meeting, report what is expected and what went wrong and what was not planned for. Most other developed and emerging markets have adopted the best practices. Combined Code of United Kingdom, or Chrome Code in Germany, or the King 2 Code in South Africa. Absolutely impeccable example of corporate governance. Remember, these codes are voluntary. These codes are enforced by shareholder, and these codes have their benefit to the core. You will ensure this will ensure the sustainability of the firm in the long run. Most of them operate and comply or explain the approaches. The media also play a vital role in understanding, in disseminating, and in educating the good, bad practices. Thereby this needs to be highlighted, this needs to be broadened, this needs to be espoused upon it. Everybody should embrace the corporate governance code. The country perspective countries in Africa have tended to adopt a hybrid approach whereby they follow probably comply and explain approach, but have enshrined some other principle in law to assist those enforceability. This reason is the weakness of the shareholder basis of the media, as the case might be. You need to understand this thing thoroughly altogether. So why corporate governance? Because it gives, if you have a corporate governance, believe me or not, your reputation gets enhanced automatically. Once your reputation gets enhanced automatically, there are other banks, financial institutions who are waiting in the queue to give you loan. Why? Because they are aware of your operation. They are aware of the business growth and the potential that you are doing around it. So that means better access to external finance, or should I say lower cost of capital. Interest rates are soft, improved company performances as a result of corporate governance. Things are very much transparent, things are very much in a know-how, and people will think twice, thrice, four times, five times, probably repeated times before doing anything wrong within the company. So it's a higher firm valuation and a share performance. This itself leads to reduced risk of any sort of crisis, any sort of scandal, and probably the other way around. This means that your growth is ensured and quadruples with the passage of time. It grows by leaps and bounds. With this, I come to an end of this presentation. Thank you for watching this presentation till the end.